All right. Another big stream coming at you today. Not only are we going to have, this is a bit of a surprise, not only are we going to have Matthew Schultz on to talk about the company and the new era and its future, but we're also going to have the CFO, Gary Vecchiarelli, join us at the bottom of the hour. So we have a few minutes to get everything settled here. I see Tyler's in here. I see Nitro Bricks is in here. Per usual, we're in members-only mode to control some of the spam. If you want to ask a question or you have comments, consider just joining the membership. Hit the join button to get access to the live stream chat. It's like $3 a month, so it's the price of a cup of coffee. I see Matthew Schultz is already backstage, and Gary will be joining us as well. So that's a pleasant surprise for everybody. We're going to discuss a lot because the last time I had anybody from CleanSpark on the channel was a little over a month ago, and so much has happened just over this past month. When it comes to all these convertible notes, when it comes to the price of Bitcoin, when it comes to deals in the sector being done, MicroStrategy, the Federal Reserve just cut interest rates by 25 basis points, yet they think inflation is going to run hotter than expected next year, so they don't know what the heck they're doing, which actually should make the case for Bitcoin even more prevalent. But yeah, I mean, I can put it on the screen here. The markets, I'm not liking it. Small cap index down 3.5%. In CleanSpark, it was up 5% at one point, and now we're down 6.3%. But that's still outperforming the other miners by almost double, which is kind of crazy to think about. Most of the other miners are down double-digit percentages. So there gives you some background on the day. We were having a really good day. It seems like the markets are really rewarding CleanSpark for this convertible note. And yeah, I'm going to have the experts on the channel here to discuss it a little bit further. We'll discuss their treasury strategy. We'll discuss their use of proceeds, why they bought capped calls and did a share repurchase. And we'll also discuss why they chose to not buy spot Bitcoin with it. But I see Matthew Schultz is backstage here. I might as well pull him up on the screen while we wait for Gary to join us. And there is Matt. How are you doing today, Matt?
Hey, good, Ben. How you doing? It's good to see you again, my friend. Happy holidays.
I don't know. This should be like a monthly thing we do from here on out or something.
Hey, don't threaten me with a good time. I always enjoy our conversations.
Yeah. So while we're waiting for Gary, I guess I'll just ask for your thoughts and what gets you so excited about the recent convertible deal that you guys just did and what makes it different from the other companies.
Well, it's an interesting tool from both sides of the equation, right? There's Gary.
Yep.
I think, obviously the big challenge is that this is a capital intensive business. And historically, we've leaned in the equity markets to raise money. So we've done a good job of it. I mean, we've generated about $2 in market value for every dollar of equity that we've raised. So by definition, it's been accretive. We've built a stack of $1 billion worth of Bitcoin. We went from, the new kid on the block in December of 2020, we hadn't mined any Bitcoin. And now, when you look at domestic American Bitcoin production, we produce more than anyone. And when you look at all the pubcos and global production, we're in the number 2 spot. So, we have achieved that through the use of equity. But, as we've talked about on your channel before, and, Gary and I get a lot of feedback on Twitter and direct messages and emails and texts and calls. And, people don't love the idea of dilution, even if, it's demonstrably accretive. So this convertible instrument is something that Gary brought to Zach and myself. What, Gary, 2.5, 3 years ago?
Yeah, about that.
Wow.
And the idea was, as you mature as a company, it makes sense to put a bit of leverage on the balance sheet. And the challenge is finding the right type of leverage and the right type of partners. So this for us, I mean, it's a 0% coupon. It gives us, we put a capped call in there. We did a share buyback. What we tried to do was mitigate the impact of any short selling as a result of the convert. But Gary, Zach, Harry, and myself spent the better part of 3 days. We had, somewhere around 40 meetings with some of the biggest institutional investors in the world, converted about 86% of them to bondholders. But the cool thing for all this, to be honest, is that these are funds that, one section of a fund at a bank may have strict restrictions against them outright holding Bitcoin or investing in Bitcoin equities. So a credit facility is a way to get exposure. And what they're interested in, obviously, is exposure to Bitcoin in a highly efficient manner. And so that's why we were able to build a cap table of some very, very credible investors. And, hat tip to Gary and Zach. It's been a huge lift. We had some terrific advisors, but I'm excited for what it means for the future. We basically, we talked about publicly that, Ben, we've prepaid past, I think we said, or beyond 50 exahash. We've got options on S21 XPs to get us to 63. And we've got we set the floor on the cheapest miners. We've got, among the most efficient fleets, among the lowest cost to mine, among the lowest energy costs. It seems to be the perfect tool at the perfect time.
Yeah. Okay. So while you're talking about that 50 exahash per second, how much cash roughly of this convertible note is going to have to go to that goal in order to meet it? And how much cash would you have left over to grow beyond that point?
Well, Gary's the guy on the checkbook, so he'd be the one to answer that.
Yeah. So look, if you look at our, first of all, good to see you, Ben. It's been a while. We had $360 million in deposits on 9/30. Okay, that cannot be overlooked. That means that we prepaid cash for machines and infrastructure as of 9/30. Okay, and most, if not all of that's going to help us get, actually all of it's going to help us get to 50 exahash. So what's left? 163 million as we sit today. Okay, we did a $650 million deal. Net proceeds are going to be about 400 million, less the 163 million to get us to 50 exahash. Okay, that's not a lot of money when you look at it on a dollar per exahash amount, right? And here's the great thing about that is that obviously we'll be incentivized to get this online sooner than later. But for every exahash that comes online, when you're mining at the costs that we have, goes directly to the bottom line, right? Like, we're not looking at additional overhead here. And you've heard me say that on prior earnings calls. Like, it's not like, oh, we're going to have an additional $3 or $4 million per exahash that's got to come on SG&A. No way, right? We've achieved something that the group calls escape velocity, because we have this scale. And now, now that we've established this foundational scale of overhead and SG&A, every incremental exahash, the majority between of the amount between spot and the cost to mine Bitcoin is going to drop to the bottom line.
So, and welcome to the channel. I think this is the first time you've actually been on the channel. But when we look at CleanSpark's future, I've kind of been painting a picture, and people thought I was a lunatic up until, just yesterday, of kind of a future where CleanSpark accomplishes some things that other companies just can't. I mean, you guys have the cheapest cost basis of any company in the world when it comes to your HODL balance. You're not using these proceeds to buy spot Bitcoin, which raises your cost basis per coin and threatens your HODL balance goes underwater, and you owe your lenders money, and you have to sell your HODL balance, which is why somebody buys your stock in the first place. I've also painted the picture of maybe a future where, as a result, we're kind of entering a new era where maybe CleanSpark moving forward doesn't have to dilute nearly as much as they have in the past, if not ever again. And that ties into my thoughts about earning yield on your HODL balance. So I have a few questions here. What are your thoughts on earning yield on the HODL balance? Because I think that's a huge future in this industry if the market for it develops. I put together a HODL yield matrix. Assuming you get to 26,500 Bitcoin by 2026, you could be bringing in $100 million plus to the bottom line, for example. At which point you're starting to offset some cash expenses at the company. Is that a reality? Like, or am I crazy to think that, the future for CleanSpark looks a lot different than the past when it comes to profitability, overall leanness of the operation, a heavier focus on immersion cooling, et cetera?
Yeah. Look, I think you're right. I think CleanSpark and really a number of mining companies have matured, right? We've been able to do that by showing up our balance sheet, getting better at operations and mining and growing HODL balance. But I'll point you back to February 2022 when it was my first call as CFO, and we chose a different direction to communicate to the market. And on there we said, hey, at some point in time, we'd love to start selling covered calls and do some things with our HODL balance, which back then was I think 300 or 400 Bitcoin, right? And to me, I think that that's just a no-brainer because you have this TradFi or traditional finance that's going to end up coming over to DeFi and Bitcoin at some point in time. We're seeing it with the ETFs, right? We're seeing it now with institutions. We're seeing it with the converts, right? You have new instruments that are coming to play. But I'll tell you that the aspect on the instruments available to generate yield on Bitcoin is still very de novo. That is in its infancy. And so the mining business itself has matured a whole lot faster than the derivatives market, for example. And it's because you still have this adoption happening amongst institutions and TradFi and just the general population of embracing Bitcoin and what is Bitcoin and what does that mean for the world, right? And how do financial markets play a role in that? So I'll tell you, it's not a matter of if, it's a matter of when. But as we sit today as a public company, we have limited options in terms of what we can do. I'd love to say, hey, we're going to go out, we're going to get 4% return on our entire HODL balance, 4% return on, which is 4% return on anything is very small. You have that risk reward relationship, right? The higher the percentage return, the more risk you have. You would think at 4%, you have limited counterparty risk and you have a limited risk that you're putting your Bitcoin balance at risk. But right now, there's not enough avenues to go put out $1 billion of Bitcoin and receive that. Okay, there might be, but we're in the process of trying to find those partners and evaluate it. So, we really take it to heart, and we really mean it when we say, hey, we're going to take this, crawl, walk, run, or dip our baby toe into the pool in 25, because we want to make sure that we're selecting the right partners and the right products, and they produce, they have the proper risk return profile that we would expect before we just put the entire HODL balance, if ever, at risk. Okay, but it's going to require some maturity. I mean, I had a call with Coinbase. I said, guys, you'd be prime to have derivatives for people who have the ability to sell covered calls or buy puts or whatever it is on your platform, much like anyone else can do through Merrill Lynch or Schwab or whatnot. Many of your listeners probably do the same thing to hedge their downside or get additional juice. That's what we envision and what we want to do. But the market is not exactly there yet. And so what we have to do is we have to go through a counterparty analysis, figure out who our partners are, what their capabilities are, how they're going to end up making money and ultimately generate yield to us, which is going to take time. And that's why we really haven't given guidance on what this is. The point is we're just getting ready, because when it does come, we should be a natural, one of the first ones in line to put up our Bitcoin to generate yield, because we have so much.
Yeah, so at least that goes through my mind. And, you have Bitcoin miners that still don't have a HODL balance. They're, if this market does develop to generate yield on your HODL, they're foregoing all of that revenue that goes straight to the bottom line, which in my eyes makes a company like CleanSpark so much more attractive to me. And then the other group is those miners that are going out and buying spot Bitcoin. But because they're buying spot Bitcoin, dilution is going to continue for the company. So I think CleanSpark's kind of in a league of its own, where dilution is going to significantly slow down based on what you guys have said. But also you have a HODL balance in the future that you could generate tremendous yield on. So while we're on this topic, then we'll go back to convertible notes. I'm just curious, you guys obviously are believers in Bitcoin long term. We're going to have some rough patches in the future. That's a given. I'm just curious, has your opinion on your Bitcoin treasury maintenance changed? The language you guys have put out has said that you're not going to close the door on selling your Bitcoin hodl or portions of it in the future if you believe the timing is right. But let's say the market to earn yield on your hodl balance develops. If that develops and you can hedge your downside, just like you said, does that make it so you maybe won't sell your Bitcoin hodl balance, even if you do maybe start to sell 100% of your Bitcoin monthly production?
The first time, or one of the first times that I was on your channel when we were talking about Bitcoin, shortly after Gary joined, we talked about the fact that we had levers, right, in our capital strategy. We could pull the lever for equity. We could pull the lever to use Bitcoin for growth. And then when the markets matured, we foresaw a time that we could pull the lever for debt. And so through that course of 40 meetings over a couple of days, the theme that was consistent, and I think, Gary, correct me if you disagree, but I think by a large majority, the institutional investors that came in on that liked the idea that we were not idealistic about our Bitcoin balance. When you run a publicly traded company and you say, we'll never sell another Bitcoin. Well, Bitcoin was $69,000 in November of 21, and then it went to $15,000 after that. And there were companies that they levered up to buy more Bitcoin between those two. So to say that you're never going to do that is really idealistic. And so we see it kind of as a strategy.
Yeah. Let me add this. I think that, and I don't think people pick up on this enough, but this is how we think. Optionality and flexibility should be synonymous with CleanSpark, right? That's how we built the business. And for us to be so steadfast and say, we will never do this. Never say never, first and foremost, right? But I don't think you can be a good steward of capital if you lock yourselves into one position. And when you hear management talk about the fact that, yeah, we would consider selling it, we might. I mean, if Bitcoin were to run, to $500,000 tomorrow, right? Like any asset class in a very short period of time. And we've seen it historically with Bitcoin. It will run up, it'll come back, right? We see a little bit of pullback today. It's had a hell of a run, right? It's run a little hot. Doesn't necessarily mean you don't believe in its future, but do you take a couple of chips off the table? I don't know. I can't sit here today and tell you exactly what that amount is because there's so many factors that go into it. Now I'll tell you, and you hit it on the head, Ben, right? Like there might be ways to synthetically do that. Okay. And going forward, I think it'd be a nice to have, not necessarily something essential, but it'd be great to have downside protection, right? So you come up with some percentage downside that you're willing to live with, and then you buy puts, longer dated puts to protect your downside. And hopefully you're buying that at zero cost because maybe you've used your yield selling, out of the money covered calls or whatever. So you need to come out of pocket for that type of insurance. And maybe that's the case. It's like, well, look, we're still able to maintain the same amount of Bitcoin balance in terms of number of Bitcoin, but the volume went down. Oh, and guess what? 95% of that got hedged because of the puts. That'd be a great scenario, right? But on the flip side, if we're going to sell, and because we mine so low, it's a double-edged sword because sure, we'll be able to take some chips off the table, but you have a pretty hefty tax bill, right? I mean, this industry and this business model can become a cash-paying taxpayer really quick, right? Because it's quite, especially since we achieved that escape velocity, the profitability can come, very, very quickly. Particularly if your exahash significantly outpaces the difficulty.
Yeah, that was going to be my next question. Like when you think about that, does harming your average cost per coin come into question a little bit? Where you have a really, really low cost per coin, but if you sell that, and then later on rebuy it, whatever, you might raise your cost basis on your Bitcoin. Does that come into your focus at all?
Not exactly, because you have to look at like capital. Right? It's like the same question. Well, do we raise capital at these prices or do we wait? And if you wait, you have no certainty about tomorrow. So we wake up every day, and you've heard this for years, right? And we live it. We wake up every day, we make decisions based on what we know and what we know what's coming and what we can control. And it's those decisions that have ROI in mind, which drive the majority of our decision making.
And another layer to that, Ben, the reason we put that $50 million Coinbase line of credit together that's secured by Bitcoin is we can now lever that Bitcoin, and we paid it off with the proceeds here, but it was 8.5% money. But we're able to put leverage against that Bitcoin without selling it, without recognizing the tax impact, and we're able to pay off that revolver anytime we see fit.
Gotcha. That makes a lot of sense. Let's get back to the convertible notes, because that's kind of been in the headlines a lot recently, and for good reason. And Gary will be kind of the expert on this, but both you tune in or chime in whenever you see fit. First of all, what is different about CleanSpar's convertibles compared to everybody else that's done a convertible? You guys were a lot more patient than the other companies were. At least in my opinion, I think maybe I shouldn't say a lot of, but a few of the other companies were kind of just in the, well, me too, I'll do it too, because it's the hot move to make right now. Where you guys took more of a, using your own language, measured, cautious approach. And it seems like you guys found the right capital and the right deal for you. But what sets your deal apart from everybody else's?
Yeah, so you're right that this was a measured approach. And as Matt had said, we've been looking at this structure for a couple of years, but the pricing just really didn't make sense compared to the other levers that we had available to us. Even back in August, we saw the convert market really heating up, but it still made more sense to open up a $50 million line of credit with Coinbase and do a convert at that time. I'll tell you that in the crypto space, this is the only 0% coupon, effective 100% up that's been done. You have some that are 100% up, but have a coupon of a couple points. This is the only one that's 0%, 100% up. And that's important because everyone knows our prudent approach to debt to this point, for which the equity raising and the ATM has really helped us shore up a balance sheet, which up to the point of this convert was a $2.5 billion balance sheet. Now it's a $3 billion balance sheet, right? With the cash that we have sitting in the account. But with that type of balance sheet, it does make sense to take a little bit of debt and use that leverage of the balance sheet. And when we looked at this, knowing that as we mature, we want to, not essentially have dilution go to zero, but to really kind of slow down that dilution and make sure that we get the best ROI. And we think that this is indicative of that. I also point that a lot of people throw around the D word, right? Dilution, like it's a bad word, right? Let's not forget, we're in the best capital markets in the world. We're publicly traded for a reason. And we do that to access the best capital markets in the world. And as this company matures, as the industry matures, as Bitcoin becomes more prolific in the world, there's going to be more capital. And with more capital that comes to the table, the better cost of capital is going to be available for companies like us. Dilution, ultimately, I don't think you should judge a company based on how many shares they issue. You judge them based on what they do with that capital, and they're taking $1 and turning it into 2 or 3. And that's what we do here. Whether it's debt or equity, we're taking that capital and we're trying to make it as creative as possible.
To give a little bit more credit to what Gary engineered here. So a lot of our peers did, a note, and it was convertible up 30% or up 35%. And they market that deal. And while they're marketing the deal, it goes public that they're going to do a convert. So it gets shorted down 18 or 20%. So by the time they put up the convert, it's really up 12% or up 14%. So we structured this entirely different. We put a capped call into the transaction, but then we did a wall cross over 3 days, 40 interviews, one-on-ones. We started, 4:30 in the morning. We were grinding, and the funds that came over the wall were under a very strict NDA. There was a no short provision. And so we priced it the way that we did. And you saw that the market impact, aside from today, just because of the Fed, but the market impact has been fairly neutral, where the vast majority of our peers have seen, 20% down before you price a 30% up deal. So it's been specifically designed for that purpose. So, when you talk about what the conversion is and how we've protected future dilution and what that premium looks like and why we spent money on a capped call and why we spent money on a share buyback, it's really for the long-term benefit of our shareholders. And, Gary's really the kind of the mastermind working with the consultants at ICR that advised us in the deal, and then with the banks, as well as counsel on both sides of the deal. I think we got what I would say, and I would argue, is the best deal that's been put up in this space.
Gotcha. There's been some talk just on the social media platforms. And I'll admit to you, I don't really understand what the argument is. But I guess the question is the cap calls, the share buyback, that prevents any net new dilution up until the share price reaches, I have $33.67 in my notes. Is that no matter if the convertible debt is converted into shares versus paid in cash, or is that only if the convertible debt is paid back in cash that dilution is protected up to that price?
Yeah, great question. So in our press release the other day, we had a chart, and that chart assumes that you pay it back at $650 million in cash. And here's why. You have to have some assumptions here. And if you don't know what the price of the stock is at the time you convert, then you really can't figure out how many shares there are. So this chart was used in another miner that did a convert, also led by Cantor. And this has actually proven to be very, very helpful to a number of institutions that we've talked to. But ultimately, the way this was designed, you look at it in terms of forward selling equity, right? Because if you compare it to if we were just to issue equity on that day, we would issue equity at 12.33. But instead, we're betting on ourselves. We're taking money at 0%, and at a very minimum, right, before you even talk about the cap call or share buyback or anything, you're forward selling equity at least at 20%, at least. Okay. So I would say pick a point where you think the stock price is going to be, and then we can drive different scenarios. But on a very basic level, yes, that analysis is based on 650 million. Now, why is that important? Well, I go back to what I said, optionality and flexibility is what we built this business on. There's so many bells and whistles in this thing that we have the flexibility to settle it in cash or shares. If when we wake up that day and say, you know what, we're able to convert this because we have a call, stock price is, I don't know, $26, $27, pick a number. This is probably what we're going to do, right? We're going to evaluate our hollow balance. We're going to evaluate how much stock we have. We're going to evaluate whether it makes sense to issue equity. We're going to evaluate whether we just sit on it, right? And that's optionality and flexibility, and that's what we really like about this deal. Now, we've had some features in here because, look, at the end of the day, we're not getting in this game just to hope that the stock makes it to $14 in 5.5 years. Let's be honest, okay? So we're hoping to make an IRR much greater than 2 or 3% a year, right, over 5.5 years. And I would guess that sometime before the 5.5 years, we are going to do something, and that might be an early conversion. It might be a partial buyout, and it might be kicking the can down the road and doing a refinance, hopefully at another 0% coupon, which hopefully is at a higher stock price, which means that all of these numbers get pushed out even higher. And the loan we just had was still 0% money. But again, it's flexibility. I mean, if I had a crystal ball, I wouldn't be sitting here right now, obviously. But given the different levers, and if we have faith that we're going to grow the business and the value of this business, the options are going to continue to open up. In addition to the macro environment that I just talked about, right? We've got a lot of tailwinds. More capital comes in the market, more instruments end up being available to us. I mean, we could take this out with, potentially a very low interest rate rated bond and pay it amortized if we wanted to, right? But at the end of the day, we have the operational flexibility, and we have the financial flexibility to really encounter and take on any of the challenges in the coming years.
Gotcha. So, we obviously like to talk about the bull case with convertibles, but what is the worst case scenario for the company here when it comes to this convertible note that you just issued?
Worst case scenario. Let me think about it. We're normally not pessimists like that. But I think that the worst case scenario, which we've already planned a contingency for, is that to assist this note getting to 0%, we took on a put. So that means in 3.5 years, the investors have a right on one day. It's one day, 3.5 years from now. It's like June, a couple years from now, that they could put it back to us for par. Meaning they could say, you know what, CleanSpark, your stock price isn't even at the conversion. It's less than 1480. We're going to put this back to you. You got to pay us $650 million. Now, that is one of the reasons why investors take on a 0% coupon at 20% up, because you'd say, God, why are they even investing in this? Right? Well, they're investing it because they're one step ahead of the common shareholders, because they're now a senior unsecured, right, and they have this put feature. Okay. But the way we look at debt, remember, has been very conservative. And we had this question from multiple institutions because they really want to know how much we were going to lever up the balance sheet. And the way we look at it is, well, look, we got over $1 billion of Bitcoin in cash right now. So on a net debt basis, cash plus Bitcoin, less this 650, less total debt, like it's zero, right? Because we have more than enough liquid assets to pay it off. And I think that, you know, when you do the math and you start to look at the numbers and how much Bitcoin we're churning out and the potential of where Bitcoin price is going to go, that's how we're always going to look at this. Because we never want to gamble the company, because we always want to make sure we have proper liquidity. And so as long as we run that net debt basis 0 or very close to 1, I don't see that downside killing the company.
Gotcha. I know you guys got to get going here pretty soon, so I want to hit the nail on the head with one last question here for you, and maybe I'll direct it towards Matt to start off with. Every other company that's done a convertible has either used it to buy spot Bitcoin, or in their paperwork they said that they're not going to rule out buying spot Bitcoin with the funds. You guys, on the other hand, have no intention whatsoever of buying spot Bitcoin. I think it's for reasons that I've mentioned and you guys have already mentioned throughout this live stream. But why is making an investment in developing your Bitcoin mining infrastructure a better ROI for the company, or IRR for the company, than going out and buying spot Bitcoin?
That is a great question, and one we've received probably 1,000 times in the last 3 days. I'll tell you why. We currently mine Bitcoin. At our most recent public disclosure, our fleet efficiency is 19.05 joules per terahash, which makes us one of the most efficient Bitcoin miners in the world. With the guidance to 37, and I would remind you that we very rarely, if ever, miss guidance. And so the guidance by the end of the month to 37, based on the S21 series of machines that we've added, it's likely that number will be at or below 17 joules per terahash. So by investing in that infrastructure, our risk goes down, because if Bitcoin is under pressure and goes down, and I've levered up to buy Bitcoin at 107, if Bitcoin goes down, now I'm negative. But by buying infrastructure and betting on ourselves, if Bitcoin goes down, companies that are mining less efficiently are forced to unplug, which increases the 4% of the global hash that we already own. So we can outpace a decline in Bitcoin price. Second, unless your name is Michael Saylor, when you lever up to buy Bitcoin and you add 1 Bitcoin to your balance sheet, your market cap increases by the value of 1 Bitcoin. Now, if you're Michael Saylor, it increases by 2.3 Bitcoin. So if you look at the way that CleanSpark is valued, take the HODL out. We have 35 exahash for round numbers, let's just say for sake of argument, and a $3.5 billion market cap. So that would impute that we have a valuation of $100 million per exahash. So by spending $160 million to grow by 15 exahash, we're creating an increase in the value. We're getting leverage on that valuation, assuming all things remain equal at $100 million a megawatt. That pushes us well over $5 billion in market cap, forgetting the fact that we're going to go from 22 or 23 Bitcoin a day to 30 Bitcoin a day. And our cost to procure a Bitcoin as of our most recent quarter was $36,250. So I would say, and then I'll stop talking and turn it over to Gary, but I would say that the reason that a lot of companies have publicly gone out and said, hey, we're going to buy Bitcoin, because if you look at their most recent financial statements, energy cost, SG&A, all in, they're mining Bitcoin at a loss. We're mining Bitcoin, I defer to Gary, but I think at a 57% gross margin. So, having operational excellence and being what we believe to be very disciplined stewards of capital, and having the highest among the top 3 most efficient fleets, lowest cost to mine, and best energy profile, and in the top 5 biggest hodls in the world of any public company, it's the right bet for our shareholders. It gives a better bang for the buck. It gives us far greater downside protection. And quite frankly, if you want to buy a Bitcoin ETF, buy Bitcoin directly. This is a leverage play on Bitcoin, which is why some of the biggest, most credible banks in the world loaned us money at 0% interest. I defer to Gary on anything else on that.
Well said. Look, I'm afraid we don't operate in a vacuum, right? And so I think so many times, particularly on social media, everyone goes, it has to be this or that. And anyone really putting their entire portfolio into one company or one instrument really needs to reconsider things. So when you step back and look at really well-balanced portfolio, even if you're overweight Bitcoin and digital assets, I think there's a room for everyone in here, right? But ultimately, buy Bitcoin. If you believe in Bitcoin, you buy CleanSpark because you believe in our ability to continue to mine significantly lower than spot. You buy MicroStrategy hoping to catch some upwind. I mean, I really don't know why they're trading at 2x plus NAV. I mean, it's good for them, but I'll tell you, some of the FOMO from everyone else that's looking to buy Bitcoin, they are not getting the Saylor effect, and I can't help but think that that's why they did it. And so again, we did this because we can control our operations, and we can almost control our destiny, so to speak. And we do. It might be a little bit more conservative of a play than some of these guys, and leveraging the entire house to go out and buy Bitcoin. But at the end of the day, we're doing what we know best, and that's how to mine Bitcoin. And I'll also point out that in a down market, if we were to buy Bitcoin, all these guys have bought Bitcoin at 100,000, and a bear market would come along and all of a sudden it's at 80,000, they're down 20,000 a coin. With the investment that we have, we will still be able to mine, and we will be one of the last ones to turn off amongst all of those miners still, which means that the lower Bitcoin price goes, if you believe in the long-term thesis of Bitcoin, the lower Bitcoin price goes, more than likely, the more Bitcoin we're going to mine. And if you zoom out or zoom forward 4, 5, 10 years, whatever, that Bitcoin's going to be worth even more. Meanwhile, those guys are down mark to market $20,000 or more. So that's what we're doing. It might be more conservative, right? But at the end of the day, we will always have mining operations we can count on. We are investing in infrastructure that's not going anywhere, that we will always be able to put the latest efficient machines in it. And that's why we did it.
Oh, I'm so glad you made the case for that, because I've been sharing similar sentiment to my viewers and my audience. And I actually have done the math, and I know you got to make assumptions about network hash rate and difficulty and the price of Bitcoin, et cetera, et cetera, et cetera. But when it comes to bang for your buck, at least with the math I've done, it does yield you more Bitcoin at the end of the day to take, let's say, $500 million and develop a mining fleet out of it, a highly efficient mining fleet. Maybe a third of your spend goes to that infrastructure and developing megawatts, but you're left with those assets, and those should continue to appreciate in value over time. Sure, your Bitcoin miners, they depreciate, they lose value, but you would think that cycle, the refresh cycle, might slow down just as efficiency and performance improvements of each new generation of mining rig gets smaller and smaller. But at the end of the day, yeah, I've done the math, and you're actually left with more Bitcoin. And even those spot buyers, they have operating expenses, they have SG&A they have to pay, they have salaries, they have all this stuff they have to pay yet, and they have to get that through dilution. So I don't think buying spot Bitcoin is just this answer that solves all the problems in the world. Because when you think about it fundamentally, at least in my opinion, in the math I've done, it actually makes more sense to mine Bitcoin. But I guess I'll leave it there unless you guys have anything else to add. I know you guys got to get going, so I want to say thank you for coming on the channel, and we'll have to do it again sometime soon.
Yeah, happy to come back. It's always fun to chat, and apologies that we're a little compressed time wise. It's been drinking out of a fire hose for us the last 10 days. So, but love to get back together. Do it quarterly or whatever, and thanks, Gary, for jumping on and joining. I figured Ben would have some technical questions, and he wanted to make sure that we addressed everything to your satisfaction and make sure that your listeners and viewers feel what we're trying to communicate. And that is, we're very confident in what we're doing. Measure twice, cut once, but it's, we've done everything we can to mitigate the risk in what has historically been a fairly risky, fairly volatile commodity, which, I guess now it's shifted and Bitcoin is more of a risk off thing with the volatility in the fiat markets. So anyway, you really appreciate all the continued support, and look forward to doing it again.
Awesome.
Yeah,
Thanks,
thank
guys.
you, Ben. Merry Christmas to you. Happy holidays to you and your listeners. Thanks again for the opportunity.
Yeah, thanks, Gary. And thank you guys for spending your time with us. Thanks, audience, for tuning in. I'll leave this up for replay.
All right. Merry Christmas.
All right. Take care.